Is my screen visible?
Yes, yes.
Okay, we start the today's market talk. Uh, as I have seen, investing is about finding asymmetric opportunities. That's it. So here, when you are investing, you would lose, you will make money, but a better opportunity, a better strategy is to seek opportunities where possibility of gains wildly outweigh what you can lose. So we have to find companies with incredible management teams which move at fast pace, operate in large industries where there is a lot of scope for growth, can deploy large amount of capital at high returns over long periods, and that in case you are able to do such a kind of investment, then opportunity is not 2x or 3x, it is 10x or 20x at the end. So we have to look for certain companies like this where the potential for growth is pretty big. So let's go ahead.
Market status as I see it, Fitch Ratings downgraded US sovereign debt from AA plus to AAA. So Fitch expects the US deficit to rise, and in addition there was going to be weaker revenues and more spending. So there was going to be higher interest rate burden because presently the interest rates are higher. What happened due to the downgrade was that it led to spike in US long-term yields and sell-off in equities. Presently, the debt to GDP ratio is 125%, and financing this debt will be a challenge. Fitch says that the problem is that US cannot print dollars like it used to do earlier because right now, due to inflation, the interest rates are very high. On the other side, there are frantic attempts by Chinese leadership to prop up the economy. Chinese authorities are laying out red carpet for investors after they moved out from China. Chinese cities are launching property support measures because property is a big driver of their economy. The big risk in Chinese economy is that the condition due to high debt and higher borrowings is similar to Japanese economy now, where there is low growth, and because of which these guys keep the interest rates low, and hence there is no inflation, and the economy just remains at the same level forever. Indian economy meanwhile is showing very strong growth momentum. July composite purchasing managers index, that is PMI, came at 61.9, a 13-year high. The only worries are high oil prices. Rainfall is better now and it's surplus at this time. Area sown under Kharif has moved from uh, deficient to flat as on date. Reservoir status is low, may create a concern for Rabi crop, that is in winters, and government has imposed a export ban on rice and is importing wheat from Russia so that the inflation doesn't go out of hand. In terms of results, Indigo posted strong set of numbers helped by strong demand and lower crude prices. The international demand is picking up. Both top line and bottom line have improved. They gained market share after Gophers operations came to a halt. If you're looking for long term, you may buy at around 2200 to 2300 range. Titan, the jewelry segment margins affected its Q1 due to aggressive discounts and the stock has corrected. Though the management in their commentary is confident of margin recovery in subsequent quarters and has retained FY24 margin guidance of 12 to 13%, the Q1 margin came at around 9.5%. So that means in the subsequent quarters, the margins are likely to be higher. Revenue growth though is 26% year on year. FY24 EPS would be around 38 to 40. So all segments are doing well: jewelry, watches, and eyewear. Present jewelry segment market share is around 7%, and they are aiming for double digit by moving to southern and eastern parts and also abroad. So if you can get it at around 2700, that would be a good level to enter. Regarding Bharti Airtel, forgotten stock, operating margin continues to improve, surprise positively. Operating leverage is helping the margins. They have been managed to get their ARPUs up, that is average revenue per user, and an increase in the number of subscribers. How this has been done is because they're going for high value customers and rising data usage, which is improving the ARPUs. ARPUs have reached around 200 now, and Africa business is outperforming. With 5G rollout, ARPUs are expected to reach around 250, maybe another 2-3 years. So buying at around 860 for a target of 1000 plus would be a good opportunity. Maruti, they did multiple launches in SUV segment and operating leverage is now helping them. Though there is also a softening of raw material cost which has helped the company to expand operating margins. But with steel, aluminum prices moving up, margins will be under pressure. Acquisition of Gujarat plant from parent dented the sentiment and brought the stock prices down. Year on year volume growth is around 6%, but revenue is up 22% and FY25 EPS at around rupees 425. It is at 24 times FY25 expected earnings. So buying at around 9,000 is a decent level. They are today only it came out in the news that they are doing a capex for 20 lakh additional units per annum. They are making around 40 lakh units in a year. Now with higher cost or higher revenue potential because of higher cost of per unit cost, so the revenues are likely to improve even if the number of units are likely to be in single digit around 5-6%. Now talking about Nifty here, if you see Nifty from the low of 16 around 800 in March has touched a level of close to around 20,000 in the month of July, right? This 3,200 point move. So if you see the now the it is retracing. So the first level to look at would be approximately around 19,250, which is 23.6% retracement, but the greater level is around 38% retracement, which is 18,784. Now if you see clearly here that from the lower levels there were 5 distinct swings of Nifty. First swing was here, second here, third, fourth, and fifth. So these 5 swings, roughly in 5 months, per one swing per month, took the Nifty from 16,800 to 20,000 levels. So watch for these levels, and as I was mentioning, that after the level of around 18,700, there were gaps as the Nifty went up. Every day there was a gap up opening and the Nifty went up. So on the way down, these gaps will have to be filled. So the fall from 19,250 once it gets broken would be pretty steep to the levels of 18,750. So one has to be careful and book out at around 19,250 level if it is breached. So if you see here, Nifty is at a critical juncture that is just at the level of 20 EMA, that is 19,541, right? And the low of 3rd August was around 19,300. So if 19,300 gets broken, there is a likelihood of a down move and it can go up. So it needs to cross the 20 EMA level to have to try to retest the previous high. In between, if you see, these are the boxes where I am showing where the consolidation took place or it rested here before the swing move took place. So these are those two boxes which are where the resting took place, and these are So once the any up move takes place and it corrects, so the two down swings is what we have to look at to see if the trend is maintained or not maintained. So the main question right now with investors is that in this decline, whether the trend has got damaged or not. So pullback up to two swings. So this is what I was talking about. Two swings will still retain that the trend status is upwards only. Once this breaks, then we'll have to reevaluate our positions. The only point here is that breaking this level would not be easy because the Nifty stayed at these levels for pretty long time. So the base is strong here. So 18,600 to 18,700 would be a strong support. Now talking about the larger market, it dipped below the 200 EMA on 3rd August, that is Nifty 500, but it quickly went back above that. So on 4th August, so these are the level. So all the people will have to watch for the 20 EMA level, and in case it remains above 20 EMA, the broader markets are likely to remain strong. Hence, the portfolios will do well. Talking about Nifty Bank, it made a low of approximately 44,250 on 3rd August, and the high or was somewhere around 20 EMA or 445 to 30. So that means there is a range of approximately 1000 points in which it is moving. So we have to see this range. Below this and uh, above this it will be positive, and below this it will lead to a fall. So we have to see which direction it moves. So this is the range to be kept in mind. But Nifty Bank is weaker because now it is trying to take support at 50 EMA, and 20 EMA is becoming a resistance for this. So the stocks which we are going to discuss today, the first one is Bikaji Food. It has a product range including six principal categories: bhujia, namkeen, packaged sweets, papad, western snacks, as well as other snacks which primarily include gift packs, assorted, frozen food, matri range, and cookies. Large pan-India distribution network, and it has a branding contract with Amitabh Bachchan till FY25. It has a market share of roughly 45%, 58%, and 29% respectively in Rajasthan, Assam, and Bihar, which collectively contributes 74.3% to the overall revenues. Now, what they are doing is they are pivoting or moving to adjoining states so as to increase their market share in those states also. So, by setting up facilities there. Going ahead, it would continue to report double-digit revenue growth in FY24, led by volume growth, penetration opportunities, and new product launches and brand building. Continuous focus is on expansion of distribution network to achieve deeper penetration across core and focus markets, which would further improve the top line. Because of higher sales growth, the margins have improved. Uh, Keeping this in mind, this year EPS would be roughly around 7.5, and FY25 would be around 9.5 to 9.7. Gross margins may improve, which may help profits due to softening in raw material and packing material prices. They have also acquired 49% stake in Bhujia Lal Ji, another namkeen brand which operates in Rajasthan. So if you see, their sales growth has been uniform and has been increasing now. We have to see the year on year growth. So that was reasonably good, more than 10% growth year on year. The margins are also improving. Now they have reached around 13% now. The PAT is also improving, and EPS is also showing an upside. The ratios are strong. Gross profit margin is around 30%, EBITDA margin around 13%, net profit margin around 8.7% that is expected for FY25. At current market price, FY25 would be expected around 50 times. Hence, if you give a valuation of around 60 times, it can go up to around 600 from these levels. So the EV per EBITDA is going down. Market cap per sales has also gone down, so it is becoming less costly. So if you see the growth rate, approximately it is likely to maintain 20% plus growth rate and EBIT growth rate of 30%, that is because of higher margins, and a EPS growth rate around 28% in FY28. Hence, it is being given higher valuations. If you see the chart, it had a vertical rise after June, and now it is consolidating. On the result day, it went up across 500 and then corrected, right, and closed low at lower level. So getting it at around 458, that is 20 EMA, or around 430, that is the 50 EMA, would be prudent.
Next, the stock which I find very unique in this environment of slowdown in IT growth is KPIT. It's a global technology company with software solutions that help mobility leapfrog towards autonomous, clean, smart, and connected future. First quarter results were above expectations with a 7.1% constant currency sequential growth in an environment where others are having negative growth. And the management was very confident of future being also very strong. Total contract value wins in the quarter stood at 190 million USD. They have reiterated their FY24 guidance of constant currency revenue growth of 27 to 30%, along with EBITDA margin in the range of 19 to 20%, which is very strong. And they are well positioned to maintain growth with large deals as the underlying mobility business spending remains robust. So there is no cutting back on mobility business from all the automobile majors, because these guys are still continue to invest. All these automobile manufacturers are continuing to invest in new technologies. Now KPIT did a headcount addition also, roughly around 500 people they added in an environment where others are cutting down on the manpower also, employee. The revenue CAGR, as I said, is around 25% and EPS CAGR is 35% over the next 2 years. So, though it seems expensive, now if you see the sales are continuously growing, the margins are also improving and have now reached around 19% from a 13% levels. The profits, net profits are also growing and now it is somewhere around 4.89 in this quarter. If you see the financial performance for the last 3 quarters, for the last 2 quarters, and compare with the Q1 FY23 for this, there is a year on year growth of around 49% in dollar revenues. Otherwise, it's around 60%. Margins have improved, and profit and other issues are also improving. So Q on Q growth of EPS is around 20%, which is good. And these are the total deals they have, contracts they have earned. So every quarter they are getting big contracts. So there is a revenue visibility because of this. Now let's see the chart. I will disclose I am trying to accumulate this one at around 20 EMA nowadays. So at around 1070, I am accumulating this thing. On 4th August, it had a spike, but I am actually buying it at these levels regularly. So in my view, this is the one IT stock where I feel that there is a decent future. Now talking about Syrma SGS. Syrma SGS is an engineering and design company engaged in electronic manufacturing services. Now there is a difference in EMS nowadays. There are two types of EMS companies. One is who are just doing contract manufacturing, and then there are other ones which are doing both. That is designing also. So it is the designing ones you must look at because they are the ones which have higher margins because they are involved in designing of the products also. Now, this company provides integrated services and solutions to OEMs from the initial product concept stage to volume production through concept co-creation and product realization. The product portfolio is there: printed circuit board assemblies, radio frequency identification products, electromagnetic and electromechanical parts, motherboards, memory products, that is DRAM modules, solid state, and USB drives. So the revenue contribution, if you see, automotive is around 14-15%, consumption is around 23-24%, healthcare around 14%, industrial around 45%, IT around 2.3%, and railways, they are also there around 1.2%. So they are covering a wide field. So there is no risks as one sector may slow down or something like that. But if you see the quarterly results, the June quarter was lumpy, right? Was poor, where the basically the margins declined and hence the profit also declined. But that is also basically because of the decline in margins. So the EPF and EPS and everything else declined. So even if though there was a if you see there is a top line growth year on year of around 54%, but EBITDA margins corrected now to around 6.1% due to lower contribution from healthcare business, which is the high margin business they are having. Though they have guided for a double digit margin in FY24, and they have got a order of roughly 1100 crore for making utility metering systems which will be exported to US markets. They have reduced, I'll show you subsequently, they have reduced their working capital uh, cycle and the receivables days and all that. So that part is working good, right? So their debt would reduce. So that means their cash flow situation is becoming better. So they have reduced the working capital cycle to 67 odd days, and they did a acquisition now, acquired a 51% stake in Johari Digital Healthcare JDHL, a medical devices company based out of Jodhpur, for a consideration of around 260 crores. This acquisition marks the company's foray into medical device businesses and it will help them grow this business. The acquisition to add 5 to 7% to their top line and 1 to 1.5% to EBITDA margin. Uh, the this Johari Digital Healthcare is already operating at a ROE around 30%. So it will improve the margins of this Syrma SGS. So if you see their basic ratios, you see the year-on growth of revenues is good now. Earlier it was stronger, but now it is stabilizing around 30 to 40%. EPS growth is around similar. Margins are improving, and ROC is also around 11%. So if you, as I was mentioning, working capital days are improving, so the debt will, receivables days will reduce, and they are able to turn over their assets very quickly. So that means that the sales are improving, and net interest coverage ratio is also good. So just 8 months. So that means the debt is manageable. Now let's see the chart. You see it is now taking support at around at the 20 EMA, stuck there roughly around 473. I would be very interested if it comes to this 440 level in case I'm looking for long term investment, because it had a vertical rise, but now it is consolidating, and in case on bad days it comes to these levels, these are the levels to accumulate these stocks. Now, just quickly, I'll go over this strategy called bull call spread strategy. It is best implemented when the outlook on stock oblique index is moderate and not really aggressive. So, what we have to do is we have to set up option positions in such a way that we protect ourselves from the downside in case our call is wrong, and the amount of profit that we make is also predefined. I'll show you how. So, as a trade off for capping our profits, we get to participate in the market at a lesser cost. So, we'll see with an example. What we have to do here is buy one at the money call option and sell one out of the money call option for the same stock and or the index and same expiry. One at the money and one out of the money call option. There is a high probability that the index stock should stage a relief rally. However, we are not completely bullish on this. Hence, we are taking this strategy so that we don't lose much in a downtrend. So, this kind of a bull call steady spread strategy, which I am talking about today, why? Because the present situation is like that. We are expecting there is likelihood of a relief rally, but we are not 100% sure. We are not completely bullish. So we just want to avoid a downtrend in the present market. So as per our conviction. So this is the Nifty option chain data of the next week's expiry. So we'll just see how we take this, use this data. Nifty spot is at 19517. At the money 19500 call premium is 102.55. Let's see here. 19500 call premium is 102.55. And also sees 19700 call premium is 25.040. So out of the money call which we are seeing is 19700 call premium is 25.40. So if we take these two positions, the cash outflow is the difference between debit and credit, because once you buy a call, you pay the premium, and once you sell a call, you get the premium. So the net debit and credit is 102 minus 102.55 minus 25.4, that is 77.5. So in a bull call spread, there is always a net debit. So we will pay a net debit is 77.15 for taking this position. So let's take one first scenario. In case the market expires at 19,400, that is below the at the money call we have bought. So what will happen here is that the 19,500 at the money call option will have zero intrinsic value, and we would lose the entire premium we have paid, that is 102.55. The 19,700 call option also has zero intrinsic value, but since we have sold return this option, we get to retain the premium of rupees 25.4. So, in case our opinion on the market goes wrong, that it is moderately bullish, our net payoff here would be roughly 77.15 is a loss. This is the net, which is also the net debit of this strategy also. Just remember this. This is the net debit also of this strategy, and that is our predefined loss on gain. I'll show you how it is. So the net debit of this strategy is minus 77.15. Now let's take another scenario. Scenario 2. In case the market expires at 19,700, that is at the higher strike price, that is out of the money option price which we had taken. 19,700. We had taken a 19,700 call and sold that. So in case it expires at 19,700, the intrinsic value of 19,500 call would be max of 0 oblique spot minus strike, that is 200. Since we are long on this option by paying a premium of 102.55, we would make a profit of 97.45, 200 minus 102.55. So the intrinsic value of 19,700 call would be still 0. Therefore, we get to retain the premium, that is 25.4 rupees. Net profit would be sum of these two, that is 122.85. Just remember this figure. The net profit will remain this also still subsequently also. Now let's see scenario 3. If the market expires at 19,800, that is at a higher strike price to the out of the money option, that was 19,700. The intrinsic value of 19,500C would be 300. And since we are long on this option by paying a premium of 102.55, we will make a profit of 197.45. Intrinsic value of 19,700 call would be minus 100. Therefore, we lose 74.6. 25.4 is the premium which we got, and we have lost 100 rupees here. So we lose 74.6. So net profit would be 197.45 minus 74.6, that is 122.85. So it is the same here also. Net profit was 122.85. Net profit will be still be 122.85. So what we understand here is, in this strategy, irrespective of the down move in the market, the loss is restricted to 77.15, and the maximum loss also happens to be the net debit of the strategy. So maximum loss is 77.15, and maximum loss is also the net debit of the strategy. The maximum profit is also capped at 122.85, and this also happens to be the difference between spread and strategy's net debit. So the spread in this case is the difference between higher and lower strike price. The higher strike price was 19,700, the lower strike price was 19,500, difference 200 minus the net debit. So the maximum profit is also capped at 122.85. So when I mentioned initially that in these things there is a our we our profits are also capped and our losses are also capped. So even if you go wrong in buying, if we had just bought a Manila call, that is just bought the 19500 call, our losses would have been the exact premium. But here, the losses have been reduced because of the premium which we get from selling the one out of the money call. So this is the basics of this strategy, that is bull call spread strategy of the Nifty. There is another thing which I'll cover next time. This is called bear put spread strategy. But in case you are moderately negative on the market, you can take that strategy. So as we have seen that you may take long strategies of buying options, but selling options, is safer for us. And because I don't have to have very strong conviction while I'm selling options, my conviction has can be more liberal, simple. I am not betting on any quick up move or on a fall or on Nifty staying flat. All I am betting is in case I buy a 19,000 or I sell a 19,000 put is that Nifty will not fall below 19,000. So when I write 19,000 put option, or I also write 20,000 call option of Nifty, I am only presuming that Nifty will not go above 20,000. So hence the risk is less, and that it is not affected by time decay. So this was the key issue which I wanted to cover. Now we will take questions. I have finished.